Look, you're all very welcome to this morning's webinar, a EURES cross-border tax briefing, a seminar on tax and social security implications for cross-border workers and employers. And my name is Paul Clancy, I'm CEO of the Chamber. And look, we're delighted that so many of you could join us this morning. A very special welcome to our expert panel members, Orla of Orla Rafferty Consulting and Rose of Tierney Tax, who are here again to provide workers and employers with information on social security and tax issues in cross-border situations, and also provide information on the implications for companies with staff members who work on both jurisdictions. And although we have a number of presentations this morning, there will be time to ask questions at the end. And please feel free to put these questions in the text box at the bottom of your screen, and we will try and get to as many of them as we possibly can. And could you please keep your microphones on mute? We have a very large number on the call this morning, and just to keep everything smooth, if you could put them on mute for us, please, that would be fantastic. So before I go through my short presentation on EURES, I would like to hand over to Dawn McLaughlin, President of the Londonderry Chamber of Commerce, just for a few words.
Thank you, Paul. You're all very welcome to our meeting today. Like, as a chamber, our partnership with EURES has been invaluable for both our members and for Northwest business in general. And it is a testament to the sterling work carried out by EURES that we have registered 200 for today's event, which is totally amazing. For us, our daily cross-border interaction is seamless. However, the complexity of cross-border tax is a minefield, which few understand and which raises many issues over the years. And as an accountant, I see it coming back to bite people maybe several years down the road. And you know, it's when people least expect it, and that relates to both employers and employees. So for me, events like today are really invaluable. I would like to give a big thanks to Joe Lavery, EURES, and the Department of Social Protection for making this happen, and to our speakers who have a wealth of experience between them. I would also like to acknowledge Tony and Michael from the Letterkenny Chamber for their contribution today. And given the time is so short, I will hand you back to Paul to give you some background on EURES. I would like to thank everyone, and I would like to think that you'll be able to take something away from today's event that will be useful to you in the future. So thank you all so much.
Thanks very much, Dawn. So look, I'm going to share my screen here. Share. And hopefully everybody can see presentation there. So EURES cross-border partnership, Ireland and Northern Ireland. I have about 6 slides I should like to take you through. So look, what is it? We are one of 8 cross-border partnerships across the European Union. Our cross-border partnership covers all counties in Northern Ireland, and also Louth, Monaghan, Cavan, Donegal, Sligo, Leitrim in the Republic of Ireland. And we have EURES advisors specifically trained in the European cross-border affairs, and a full-time coordinator, which is Joe, which Dawn mentioned there earlier, to organise the day-to-day activities of the partnership. And the organisation is made up of representatives from the Department of Communities in Northern Ireland, Department of Social Protection, Republic of Ireland, the Londonderry Chamber of Commerce, Dundalk Chamber of Commerce, the Irish Congress of Trade Unions, Unite the Union, Confederation of British Industry, and the Irish Business Employers Confederation. And just in case, I will be sending you a copy of these slides as well, along with the slides of the presentations that Orla and Rose will be doing later. So don't worry about taking notes. The aims and objectives of EURES. Well, the EURES cross-border partnership supports cross-border workers, job seekers and employers in the Ireland/Northern Ireland border region. For job seekers and workers, we provide information on job opportunities, working conditions, training opportunities, and tax and welfare conditions. And that's one of the purposes of the webinar this morning, is the whole tax and HR implications. And also for employers who provide information on the supply and demand of labour that exists and support recruitment across the border, which is a very important element of it as well. So we run a series of events in terms of employer supports. These include cross-border job fairs. We're looking at virtual ones now, obviously, because of the difficulty of having face-to-face. Employer incentive events, employer awareness raising, English for employability, cross-border query support, employer signposting, and reciprocal processes for promoting vacancies across the border. And further support is available. We have a range of material, printed and electronically. You know, we have mobility packs, leaflets, brochures, and we have a new website as well, www.eurocrossborder.eu, and we have a social media presence via Twitter, Facebook, and Instagram. So some of the issues we cover, and some of them we'll cover today, are like things like currency, taxation, benefits, healthcare, qualification, recognition, EU settlement scheme, frontier workers, permit schemes, and COVID-related issues, which are obviously very topical at the moment. So look, that's a very short run through what EURES is about. We're here to help. We're delighted that so many of you could join here. And without further ado, I'm going to hand over to Orla to take us through her presentation.
Hi, how are you doing?
And if I could just ask everybody just to put their microphones on mute, please, that'd be great. Thank you.
Hello? Sorry, I've lost you there. Yeah. Yes, I can hear you now.
So, Orla, can you hear us all right? Yeah, you're just on mute there, Orla.
Okay. Well, I'm not sure why it's doing that, but you should be able to join the event, okay?
Anybody want to do one of these before I do that? I think I can hear Anna there as well.
I'm just trying to get her there now.
So I just want to check that everybody can see my main screen okay?
We could, it was there a second ago.
Can you see it now, or is that just my
I can't see your presentation there, Orla. No, I can't, not unless Dawn can see it. I don't know, Dawn, can you see a presentation?
No, it's not coming up. It did come up a moment ago.
It came up a second ago, right, Orla, yeah.
Okay, hang on a second, we'll fix that for you. Okay, I think this is probably going to be the best thing for me to do here. Okay, can you see it now?
No, Orla, no.
Okay, sorry, apologies. Okay, maybe if Rose, if you want to pop on there and I'll try and sort this out, maybe that might help.
Yeah, you're on mute there, Rose.
Do you want to change the running order, yeah?
Yeah, or change if or just needs a little time just to sort out that presentation there.
Yeah,
so,
I don't know what's going on here, so
so
apologies, guys.
Yeah, we got you there, Rose. Yeah.
You got my screen yet?
Yes.
Sorry, Rose.
Okay, we'll jump in here anyway. Okay, so this is going to be a quick run through some of the issues that are sort of we're facing over the last while in terms of COVID, Brexit, tax, everything that's been going on. And just a bit of an update as to where we are from the last time, because these things keep changing. Reliefs come and then they go, or they come and then they're confusing and then they go again and then they come back again. So it's been a moving feast the whole time. Remote working, very big topic. You know, will and can it last? In some areas definitely, and in other areas it's questionable. And I suppose now that the whole thing has sort of been dragged on for over a year and it's ever changing, you know, there's such an impact on all workers, but especially cross-border workers and employers, and that's really being felt. So let's have a run through some of the issues. An update on some of these rules. We're going to go through the residence test and the cross-border workers relief, where they're at now. And so a mention of the subsidy and furlough schemes, and then state pension benefits, and also the remote and working from home. So the residence test, anyone familiar with Irish residence test was, you know, it's all based on time, how much time you've spent in the calendar year in the country or in the last 2 years combined, 183 days in the year or 280 days over 2 years with at least 30 in each year. So if you're 183 days in the year, you're resident in that year, but over 2 years, if you're 280 days over 2 years and but maybe not 183 in either, you're still resident in the second of those 2 years, provided you had 30 days in each year. But of course, if you weren't able to move around because of COVID, then there had to be some sort of relief being brought in. And there was a relief brought in, and we're using the force majeure circumstances under the treaties, and basically it was outside of your control, and because of COVID that you couldn't move around and either spend the time in the country to maintain your residence, or spend your time outside of the country to make sure that you weren't resident. So what they said at the time was that you could they'd sort of look at it on a case-by-case basis, but then they brought out guidance on this and said that a maximum of 30 days could be disregarded, but they were only 30 days up to the 18th of May 2020. So the days up to 18th of May 2020, sorry, let's see if I can get rid of that and I can see what's going on here. The 30 days up to 18th of May 2020 could be disregarded when you're counting your days for the residence test. Now, disappointingly, these don't seem to have been updated at all. Of those examples on the revenue website, it's all referring back to the days and the number of days up to that period last year in the first lockdown. But of course, we've had several lockdowns since. We're still in lockdown. And so disappointingly, that hasn't been updated, for the late 2020 and 2021 period. So a lot of people just don't know where they're at. And I would say the advice in relation to individuals is that when you're filing your tax return, or if you're going to claim reliefs or anything, that you need to look at it very closely, and you may need to take advice, because each one's going to have to be looked at individually as to what your own circumstances were. And for anybody doing tax returns for people, I think you're going to have to treat everyone on a case-by-case basis, because everybody's is going to be different. There's going to be reasons why people didn't move around, and they might not necessarily be COVID related. It could be that they went to stay with family, to look after family, things like that. And it might necessarily be to do with the fact that they were restricted from traveling. And you have to look at each case individually. The UK residence test, of course, it's based not only on counting days, but also the ties to the country as well. So it's possible you can have, a lot less days in the UK, but quite a number of ties that still make you resident there. But the UK HMRC said was that you could exclude 60 days from the calculation, but these were 60 days that because of certain circumstances. So if you were quarantined or advised to self-isolate, you could exclude the 60 days. If you're advised not to travel from the UK or unable to leave because of the closure of borders, or you're asked by your employer to return to the UK temporarily, or you're required to come to the UK to support a vulnerable family member who'd been asked to shield or self-isolate. As long as those reasons were as a result of the virus, then you could exclude these 60 days in calculating your days for the purpose of the residence test. But other than that, that's all you can do. There's no further updates on this, disappointingly as well, I say, because although I suppose these rules are driven out of London for the UK, I mean, Northern Ireland has been in, a series of lockdowns, and so is the northern half of England as well. So there's certain parts of the UK that have suffered worse for lockdowns than others. And it just seems like there's been a policy made there not to update this stuff, just to work on the basis of last year you got a bit of relief, this year we're not exactly saying whether you're going to get any or not. Now, a very popular relief in this region, obviously, is for those resident in the ROI, is the cross or trans-border workers relief. And that's where you retain your residence in the ROI, but you take up a foreign employment in a treaty country. So that could be Northern Ireland. And you commute either once a day or once a week, but at least once a week. So a lot of people who are working, say in the UK, they might come back every second weekend and come back on a Friday and leave on a Monday, and that counts as a day in each week. And that works for that particular relief. They retain their Irish residency. And so long as you're paying tax in the other country through the payroll, and the employment lasts, it's actually 13 weeks, it says in the legislation, but a 3-month period, and it's not your own business, you're not a proprietary director, then you don't pay any further tax or USC in the ROI on that UK employment income. Now that is, qualify that by saying that's assuming you've got no other income and you're not jointly assessed with a spouse, because it's based on a formula. And if you have other income, then you don't get full relief, because it's based on your, the relief based on your foreign employment income over your total income. And so the bigger the denominator there, the less relief you're going to get. So in a lot of instances, I would have advised people that, if one person's working across the border or in the UK and the other person isn't, in a married couple, that they should go on separate treatment so that they're taxed individually. Now you're allowed to do that anyway, because in fact it's in the rules that you're meant to do that anyway, because if one is non-resident, you would have to do that. But if you're obviously retaining residence for the purpose of this rule, you could still be jointly assessed. But if you were separately treated, you're treated as individuals, so your spouse's income doesn't skew the formula and you can get full relief. But of course, then if you quit that job in the UK and you move back and you want to get back into joint assessment again, you have to elect for it in the year. And Revenue got very strict on this point. And there's been several cases turned around and said, hang on a minute, you didn't elect to go back into joint assessment. And a lot of individuals wouldn't know that. That you have to, when you change from one basis to another, you have to make an election. It's usually within the tax year or prior to the tax year. You need to be sort of on top of the thing straight away to make sure that you make that change at the time when it's relevant. Because you could be the following year after you've changed that position that you've figure out, well, actually I should have done that last year, but it's too late then. You might still be able to be in time to do it for the year that you're in and filing the tax return, but you still might be too late in that year as well. So you have to sort of look at these things on a timely and a real-time basis. Now, the COVID rule in terms of relaxation was that, even if you didn't manage to meet the criteria of commuting once a week, because basically you were working from home or you were stuck and you couldn't move around because of COVID-19, then you still were entitled to the relief provided the other conditions were satisfied. Now, thankfully, that relief has been extended to cover the tax year 2021 as well. So that's quite welcome. So for both 2020 and 2021, that relaxation is still there. And of course, 2021 was up to December 2021 in the ROI for tax purposes. On the wage subsidy scheme and the furlough scheme, that slide there sort of summarises how they worked. And most people are sort of familiar with this stage. TWSS is like a distant memory now at this point, but a distant memory in some senses in that it's distant memory for the employees, but it's not a distant memory from the employers, because the way it was administered and the way that it's still currently being administered in terms of how the mop-up process is going on. In other words, the reconciliations. Revenue are currently in the process of clawing back TWSS. We're at the beginning of the TWSS number of the first few weeks. They hadn't got the system set up to give you the accurate payments for each employee. So what they did was they give a flat rate, and now they're clawing it back from the employer. So this is after the year end, when everything else was meant to have been sort of figured out by the year end of December, and they're now clawing it back from the employers. The employers have to put in their reconciliation by June, and if they have already repaid overpayments, which a lot of employers did, they're not turning up on these reconciliations that revenue have put on the individual records, the Ross records of the employers. So they can just gone into some big black hole in the Collector General. You're just going to have to be found and allocated to the employer. So there's a lot of turmoil with that system in terms of the administration of it. It was very, very, very welcome by businesses, because otherwise wages couldn't have been paid. But it was just the administration of it was cumbersome and convoluted and complicated. And I think there's still employers tearing their hair out over it. The UK furlough scheme was a little bit more straightforward. It was taxed as normal through the payroll, and so it shouldn't require any adjustments at year end. Whereas the TWSS in the ROI meant that the employees had a tax liability at the year end, which was very unwelcome from an employee's point of view. But it was because the TWSS wasn't taxed on their pay slips when it was given to them. And that was the rules of the scheme. The EWSS replaced the TWSS then, and it's still running along for employers that qualify for it. But not a lot of employers will qualify for it in terms of they have to have a certain level of turnover drop in their businesses for this to actually work for them. And in some cases, it just doesn't work for them at all. And there's going to be tax implications, in relation to that too. Now that is taxed through the payroll, so it's slightly different to the TWSS. The UK furlough scheme has come, it's been phased down, it's brought back again. So there's, the reduced rates applied up to October, and then now it's been increased again to the maximum monthly wage of 2,500. We'll probably see it's just dissipating now as the UK is opening up again. The employers pay national insurance and pension contributions for both the hours worked and the hours not worked. I suppose that was to keep the records right in terms of, contributions for pension purposes, etc. The end of year impact, I suppose, for the employees was even more complicated for the cross-border worker, because you're required to file an UK tax return with HMRC where you've got foreign income, and if you availed of the TWSS through your employment in 2020, it means that tax in USC wasn't deducted on part of your income. So when you go to calculate your liability for the purposes of filing your HMRC return for the period that covers 2021, because mostly the TSS would have been paid in the tax year 2021, very little of it in the tax year in 1920. So that means that you haven't got that tax paid. So when you go to take your double tax credit, it looks very low in comparison to the UK equivalent tax on that income. But what it actually says under the treaty in terms of double tax credit is that it's the Irish tax payable that you deduct as the credit. So that means is that even though the tax wasn't paid through on the pay slip or through the payroll, it's payable at the end of the year, either by a reduction in your tax credits or just as a lump sum, whatever way you want to pay it as an employee. And there's also a facility that an employer can pay it too, but they're not obliged to, but they can. So it's the Irish tax payable that you actually deduct. So it'd be nice if you could actually work that out sort of simply. And it's not an easy task, sometimes particularly if you've got other sources of income or you're jointly assessed with a spouse, because your tax credits and that might be shared. So the end of year summary that's available in the My Account should show you the balance of taxes payable on your own statement. But that also takes into account other things you might have claimed. You might have claimed medical expenses relief. You might have claimed pension relief. Other things could have reduced the amount of tax that you have payable. So that might not be the right figure. Working it out is actually going to be a bit of a torture for most people. And I think the fact that you're allowed to spread the payment of it as well, it means it's going to impact future years as well. So if you start paying it or having your tax credits reduced from 2022 onwards, which is one of the options to claw back the tax that you haven't paid on that TWSS as an employee, it's affecting future tax years as well. So your tax credit is skewed in terms of working it out for your tax return. So if you paid, extra tax and USC in 2022, 23, 24, and then suddenly you have to do your tax return, you're going to have to adjust that figure because you can't claim all of that. It's not relevant to that year. It wasn't tax payable for that year. It was tax payable for the earlier year, which is 2020, 21. So it's not simple, nothing simple here. So what I'd suggest is that even though they're probably not going to do this, it'd be nice if Revenue could provide you with that figure, wouldn't it? Because they've got all the information, they can work it out, they have it all in their systems. So what exactly is your double tax credit? So, why not ask them to provide it on the end of your statement within the ROS system? Because everybody's got a My Account as an employee, once you're registered as an employment. And so in your own personal My Account, why couldn't they provide that figure? What exactly is the available double taxation treaty credit, for the calendar year 2020, and then again for 2021, so you can work it out and apportion it. There's a little letter I've shared before in relation to maybe asking for that. If people wanted to do that, so you send that as a standard letter into Revenue and just asking them to basically provide that information to you. It's the tax payable figure that you need, not the tax paid figure. So tax and USC payable. And if they could provide that, wouldn't that be wonderful? Now, a more recent announcement back at the back end of last year, sort of around Christmas time, there was a recent announcement that the Revenue said that the underpaid taxes of an employee because of TWSS could be reimbursed by the employer. Now, employers weren't obliged to do this, but it was an option there available to them, and still is. But a lot of employers had tried to sort something out by the year end, and they didn't know about this. It wasn't announced until late in the day. So some employers had tried to make up the difference in wages if they could. Some employers would have difficulty doing that. Some employers just can't afford to do it and never probably will be able to. And now the fact that there's even TWSS being clawed back from the employer, they're sort of confused as to what the figures actually are. So another thing that they announced at the time was that if the employer paid this on behalf of the employee, this is the underpaid tax and USC, that it wouldn't be taxed on the employee as a benefit in kind, but it wouldn't be tax deductible for the employer either. Now, that's Revenue's view that it's not tax deductible. My view is that it is tax deductible for the simple reason that what they quoted at the time in their own guidance notes was that under Section 81 of the Taxes Act, which is the basic section for how you calculate the taxes, say, of a sole trader, what you add back, what's not deductible, etc. They said that income tax is never deductible under Section 81. And in fairness, Section 81 does refer to income tax not being deductible. But you've got to look at it in context of the section. The section is about calculating the taxes of, for example, a sole trader. The sole trader's income tax, his own income tax, his or hers, is never going to be deductible in calculating their profits, which is then going to be taxed. Of course it's not, it's after. That's exactly what you're calculating. So to me, it was somebody who read that section and didn't read it and interpret it in the way that it should have been interpreted. The income tax of an employee of a sole trader that is part of the gross wage of that employee is clearly an expense of the trade, and therefore is wholly and exclusively incurred for the purpose of the business and is tax deductible. Now, this is a bone of contention, and it's part of the lobbying process with revenue as to that things are just wrong here. Can you please correct this? So it's one of the items on a very long list that the institutes have been pushing to get this reviewed and get this actually corrected. So there's been difficulty in calculating this underpayment for the individual employees as well, because when you think about it, the underpayment for the employee is skewed then by other things that have gone on, like I mentioned, pension reliefs, medical insurance relief, joint assessment with the spouse. So the end of year statement that you might get for the employee might not be the true figure that relates to the underpayment that directly relates to TWSS. And how do you work that out? How do you work that back? There's such a disincentive here for any employer to get involved in it because it's become so complicated. And of course, the employees might be expecting it when they know that it's available. So there's a lot of bones of contention here. It hasn't made the situation easy in a lot of businesses. State pension and benefits then, how have they been affected? Well, so those in receipt of PUP and TWSS were not paying or being credited with social insurance contributions. So there's nothing going on. So you say that could end up with a gap in the record. But it was announced there in the Social Welfare Act in 2020, the Amendment Act, that those in receipt of the TWSS or PUP or job seekers because of COVID-19 are deemed to have made a social contribution. And the class that they're deemed to have made it at is the class that they were previously paying. So if they were an employee paying Class A, then the deemed contribution is also of Class A. So that should minimise the impact on the social welfare benefits and state pensions as well in the future. So that's a good move and a straightforward move from that department, which is very welcome. PUP recipients then in 2021, so during 2020, obviously PUP was not being taxed at source, so the credits weren't being adjusted to account for it, and ended up being part of the underpaid taxes of the individual at the end of the year. In 2021, PUP has been taxed on a real-time basis by the adjustment to the tax credit. So any tax dues collected by reducing the person's tax credits while they're on PUP and reducing the rate band. And then these adjusted tax credits and band are applied on a week one basis during the period that PUP is being claimed. And the individual is notified by this, and there's a revised payroll notification and RPN available to the employer as well. Those taxed under joint assessment where they've got insufficient credits themselves, the spouse's tax credits will be reduced to take account of the fact that there's PUP being claimed. So we've had a number of phone calls into my own practice about why my tax credits being reduced, and realise because the spouse is on, it's claiming PUP during that period, that they didn't realise that their own tax credits could be affected by that. But on a return to work, the credits are adjusted again, and so they're readjusted back to the normal level. So in most cases, this should mean there's no additional liability at the end of the year, but I suppose let's wait and see how it all figures out in the mix of everything else. But that's the idea, is that it's because it's effectively been taxed on a real-time basis that there shouldn't be that additional tax liability at the end of the 2021 period. There's a lot of issues for employers as well. The main issues would be the obligation to set up payroll on the other side of the border. That's a huge issue at the minute because of all of the working at home and the remote working. There's TWSS and supports, we've touched on some of that already. There's issues around employment contracts, terms and conditions, and then policies and the tax implications of them. So there's a lot of mistaken assumptions, and sometimes not just mistaken, sometimes deliberate assumptions in relation to when you have to set up a payroll on the other side of the border. So effectively, an employee or an employer can't decide where the payroll is operated. There's a set of rules to be followed. It's all about where the duties of employment are carried out. And sometimes there's an immediate obligation to set up a payroll on the other side of the border if duties are being carried out there. But sometimes you don't have to do it immediately because there's treaty relief. So the employee or the employer can't just elect where they're going to be taxed. Payroll has to be run in accordance to those rules. And then where payroll is run is not based on the domicile or residence of the individual employee. That's relevant for the purpose of the treaty relief, but it's not relevant as to where the payroll is run. you've got to look at the employer rules first and then the employee rules after that, because the employer has to deduct tax where it's appropriate in relation to the employment. Then the individual employee has to put that on their tax return if they file a tax return, and that's got based on their residence and the sources of income and where they're employed. So foreign employer registrations in the ROI, you've got 3 different columns there. You've got where there's no reporting obligation for the first 2 columns, and then where you do have to report and get clearance, in relation to your PAYE obligations. So under 30 Irish work days, if you're not Irish resident, there's no application to revenue and it's relief under domestic tax. So there's no reporting obligations when you send an employee normally to another jurisdiction. So if you have an Irish employer, an ROI employer, sending an employee north of the border to work for them under their normal employment contract up to 30 work days, generally that's not going to be an issue. And vice versa, you've got an NI employer coming into ROI and the employee is working there for 30 days, generally that's not going to be an issue, there's treaty relief. So if it's an NI employer sending an employee to ROI, then provided that employee is not Irish resident, the treaty relief is available. And that can go on for up to 60 days. And then when you get to 60 days, you've got to do a review, because between 60 and 183 days, you can still avail of that relief, but you have to report to revenue that you're there, you're present as an employer, and you have these employees, and that if you breach the 183 days of duties in the Republic of Ireland, that you will actually return those details and you will deduct taxes as appropriate and paid into revenue. But you meet all the qualifications for the exemption in the meantime. The NI, so you've got this ROI rule that you have to set up the payroll if you don't meet those conditions in terms of the treaty relief. So if, for example, this NI employer has a ROI-based workers performing duties there, and some of those workers are NI resident and they cross the border to the work, and some of them are ROI resident. Well, the ROI resident ones, they've got no exemption for, because they don't satisfy the conditions under the treaty that they remain tax resident in NI. So if any NI employer who takes on an ROI resident employee has an obligation to set up a payroll in respect of them. This became a huge issue as soon as all employers were told, send them home, make them work from home last year at the beginning of the COVID lockdown. So a concessionary measure was taken in that says that we won't oblige foreign employers to set up a payroll in the ROI, provided it's all COVID related. But that concessionary measure ceased to apply there on the 31st of December. And that means that every NI or foreign employer who sends an employee to work in the Republic of Ireland has to review whether they need to set up an payroll in the ROI. And for all those remote workers who are based at home in the ROI, who are working for, say, NI employers, the employer should have set up a payroll. So if they hadn't done it already for various reasons, then they should have set it up from 1st of January. That's the employer's obligation, not the employees. The employees who want to work from home, should have that conversation with the employer, be sure you're doing this right. But I think there's a lot of head in the sand going on in relation to this. And particularly when I hear anecdotally that in recruitment processes, sometimes ROI employers, who are taking on candidates who are, say, NI resident, are asking them for an ROI address. And if they don't produce an ROI address, they don't progress in the recruitment process. Totally discriminatory. Because, my reading of that is that they're trying to get out of their obligation to set up a payroll in Northern Ireland on the equivalent rules. So when you hear things like that going on, you go, this is a big issue. And there's obviously a lot of lobbying things going on in relation to this at the moment, and I'll get onto that. But you see, the requirement is similar north of the border as well. So there was no full relaxation by HMRC on the obligation of an ROI business to set up a payroll in NI or in the rest of the UK if somebody was working from home during the COVID period and weren't actually travelling to their job in the ROI. So they offered some flexibility, but it was case-by-case basis. So if you already had a short-term business visitor agreement in place with HMRC, where you agree that you have employees who are working cross-border like that, you have no obligation to set up the payroll, provided you keep them informed. And then when you get to this certain number of days, you have to set up the payroll. But the conditions just were relaxed slightly, but not very much. If you were unable to leave the UK in the 2021 tax year, you could operate payroll in 100% of their earnings. And if you're unable to return to the UK indefinitely, UK tax might be reduced or may not be due, depending on the employee's circumstances. So, as I said at the beginning, case by case basis, both for the employer and the employee. Remote working is the big buzzword. Remote working was really welcomed by a lot of people, and by a lot of employers just to continue their businesses. But remote working has with it both pros and cons as well. I suppose the outcome of COVID-19 has been that there's been a bigger shift and a faster shift towards remote working than there had ever been before. And in some cases, it's a reduction in costs for employers. In other cases, there's duplication of costs because they have to keep both the work premises going and also pay for working at home costs as well. Some employees embraced it, some hate it. Some employers are managing remote working very well. Some are just not coping with it and are encouraging employees to come back. And of course, then you've got government coming out and saying, don't be forcing employees to come back. This is our policy now. You've got to continue to work from home. One of the more recent announcements was that they expect the working from home to carry on till at least September. So I presume that's when schools are back in September or whatever. Now, there's an awful lot of implications of remote working. It's broader than just keeping the job going and where payroll has to be set up. There's employer taxes, which we keep talking about because that's the topic for today. But there's also corporation tax issues. If you've got somebody working remotely for you, and say they're a senior member of staff or maybe a director, if they're making decisions on behalf of the business in the other jurisdiction, you can actually be creating a corporation tax presence for the company in the other jurisdiction, meaning that you would have brought that business in almost a branch context in the other jurisdiction and have to pay corporation taxes in relation to some of the profits. So you have to be very careful about those sort of things, about board meetings, about decision making, and maybe map out roles and responsibilities to avoid unnecessarily bringing the company into dual filing obligations. Because as I say, it's a broader issue than employer taxes. Of course, the impact of wage supports then is that where full wages weren't paid, even though they're contractual. There's a whole minefield of legal issues there, and maybe Orla's touching on those, but there's issues around discrimination, unfair dismissal, breach of contract, unlawful deduction of wages. And of course, there's force majeure circumstances that can be looked at, but I would say communication is essential, that communication in every business, just put it in writing where possible as to what the procedure is and why things are happening. And that's not easy when things keep changing by the week and by the month and by the day, but communication is essential. Some of the TWSS say not taxed through the payroll, but is subject to tax of USC, and the employer was encouraged to top up the wage if they couldn't. But if they couldn't, was it a breach of contract? Typically, maybe an employee, with their wages reduced because of TWSS, you might be missing maybe a month's wage last year. I would say put everything in writing. Others, maybe reduced hours to match the wage level. Others couldn't afford to pay and still can't. So a whole minefield of issues. And then, of course, the changes in working conditions as well, health and safety in the workplace, health and safety working at home, equipment to work from home, and making sure there's flexibility in hours, childcare issues, homeschooling, and of course this continuous cycle of restrictions and lockdowns as is wearing thin. Even in my own business, I've had employees saying, "Can we come back in? Can we come back into the office?" So there's this staggered working process going on in a lot of businesses at the minute, where people are staggering their days or their hours in the office premises or the business premises, and trying to work on that basis. It's hard to plan ahead, in relation to everything, because you just don't know, how things are going sometimes. And it says you have to go with the flow. Try your best by your employees, and the employees go easy on the employers. It's not been an easy year for anybody. Controversial new policies also being discussed, I think, at government level. Some things that are being encouraged, in other words, nearly forced on you. And the remote working thing as well. A lot of businesses say aren't coping with it, and they really want to get their employees back into the premises. There's this provision around health and safety reviews in the home workplace. There's talk about that. And sometimes these policy decisions are floated and the press grabs them, and they're all over the place. And they're floated, but then sometimes there's a blatant disregard of how this is going to be paid for. In small businesses at the minute, the COVID has caused a lot of disruption, reduction in turnover in an awful lot of businesses. That means you have an increase in costs, sometimes duplication of costs for people who are working remotely. That's pushing up the cost of employment. And when you've got asked for these extra sort of provisions on top, sort of it pushes up the cost of employment, and that has a direct relationship to the number of jobs that can be maintained. So it is a delicate balance. But there's a lot of other cost pressures out there on businesses, particularly small businesses, that they haven't even seen yet. There's a big ticking time bomb in terms of the Brexit cost increases that haven't filtered down yet into prices. And there's a huge, it's a whole different day's work there in terms of talking about that, but there's a huge there's a huge amount of costs that hasn't been factored into prices because the administrative costs and the duty costs and the additional costs that Brexit have incurred in terms of imports haven't actually filtered in a lot of businesses yet because they haven't figured it out and haven't made that price adjustment. So you add that to the increased cost of employment, and what do you get? You get a tidy mess. That's an unfortunate outcome. So I would say I would love to see a little bit more encouragement for the politicians and the policymakers to look ahead, think ahead, and to engage with the employers at all levels on this sort of issue. So the employers have been actively encouraged to promote remote working, but the problem arises when it's cross-border. And when it's cross-border, you have to set up the payroll on the other side of the border, because with the employees resident on the other side of the border, where they're now working from home, and that's where the obligation arises. There's a number of lobby groups going on at the minute, but one is the Cross-Border Workers Coalition, and they've been lobbying politicians, and press has grabbed hold of some of this stuff as well. But it seems to be, as bits I've read anyway, seems to be indicating that it's a double taxation on employees. It's more complicated than that. An employee who's working cross-border anyway already has a double taxation obligation, in that, if you're resident in Northern Ireland and you're working in the Republic of Ireland, your taxes are deducted at source by your employer, but you've got an obligation to file a tax return with HMRC. So you already have a double taxation obligation. If you're working now at home for that ROI employer, then really what they should be doing is setting up an NI payroll for you. So actually, that would actually reduce the burden on the employee, because their only employment or their only source of income is their NI employment where they live. So they don't have to file a return with HMRC. It actually reduces the amount of taxation, maybe not the overall taxation, but reduces the double taxation obligation, if you like. And the big issue there is employers. It's the employer obligation that's the crux of the matter here. And I think any lobby group should bear that in mind, that it's much wider than this issue about double taxation of the employee. You need to get the employers on board on this. And there's a couple of suggestions, maybe things to think about, maybe cross-border workers relief, this relaxation on it, but not being able to travel could be relaxed permanently for ROI residents who are working north of the border, not just for COVID. The introduce maybe the equivalent relief in Northern Ireland. Now, obviously that's difficult because Northern Ireland is part of the UK and it's the UK tax rules. Dormant taxing powers, big question mark there, as to whether they're being used, not being used, going to be used. So it's an issue as to whether or not they could make a distinction for Northern Ireland and have an equivalent relief there. Maybe relieve NI employers from full ROI payroll obligations, whether have an employee working from home in the ROI, maybe for a certain period every year, or at the moment they're subject to full registration requirements from 1st of January 2021. Or you could limit, in that case, you could limit maybe the number of employees per employer group that can be facilitated that way, and you'd have to show a necessity for the arrangement. You could clarify that, for permanent establishment purposes, for direct tax, it's not going to be, an issue is not going to be created by having that employee working remotely. So there's a lot of issues there. And I suppose there's a lot of things to discuss. A few questions came in ahead of this session, and I just want to deal with them now. Two of them related to capital gains tax. How long is there a capital gains tax liability to the revenue commissioners if a person relocates from ROI to Northern Ireland and their tax residence becomes the UK? A person, I suppose, is still within the charge to ROI capital gains tax on any Irish situate assets. So Irish land and buildings are always going to be within the charge to Irish capital gains tax first, and then also capital gains tax in Northern Ireland on the worldwide basis, with credit for whatever has already been suffered in the ROI. the ROI situate assets would be things like Irish land and buildings, Irish exploration and exploitation rights, or shares in companies that derive their value from those sort of assets. As well as that, any assets that you owned before you ceased residency, still within the charge while you're still ordinarily resident. So until the 4th tax year after you leave, you're still ordinarily resident. So if you waited a full 3 tax years and in the 4th year you disposed of an asset, that was an ROI asset but wasn't an ROI situate asset, then you could escape ROI CGT on that. But if you return within 5 years, so you resume your residency within 5 years, so you left in year 1, 2, 3, you're still ordinarily resident. Year 4, you disposed of the asset. And in year 5, you decided to move back and resume your residency in ROI. Then they can tax you on the way back in on the asset you disposed of, even when you were non-ordinarily resident, because you resumed your residence within 5 years. So you say, God, they grab all. But that's the situation in relation to ROI CGT. And then the second question is related, so if there was an ongoing capital gains tax liability, or if there's an ongoing capital gains tax liability to revenue commissioners, does this still apply if after becoming a UK resident, assets are sold at a profit and immediately reinvested into a UK tax efficient wrapper, such as a SIP? This is definitely a question from an accountant. I would say see above in terms of the CGT rules, it's hard to get out of them. But there's no rollover relief in the ROI to get out of the CGT. So the fact you reinvested it is irrelevant for ROI tax, you reinvested it in the SIP. ROI CGT can still apply to the disposal if the asset's still within the charge in accordance with the first set of rules in the first question. So you don't get out of it that easily. The next 2 questions related to cross-border workers. So what's the minimum number of hours you have to work to be deemed a cross-border worker? And does working for an agency, for example, a nursing agency in Northern Ireland, preserve your status as a cross-border worker? Is it based on hours worked? Well, the person who asked the question didn't actually say what was the reason that they wanted to prove themselves or somebody that they're working for as a cross-border worker. So it depends on the reason. So it's a fact, it's a matter of fact, you either are or you aren't a cross-border worker. But it depends what reason you're looking for, to prove it. So for healthcare, you'd have to look at the healthcare rules. For tax, look at the tax rules. Social welfare, look at social welfare rules. So if you're looking at cross-border workers relief, your employment has to be for a continuous period of 13 weeks in the tax year to be able to claim that. If you want to register with the GP and NI, maybe you're trying to jump the queue on the vaccines, then you might need 6 months pay slip. So it really depends on the reason why you're looking to prove that you're a cross-border worker. But I don't see a minimum there, in a general minimum for any purpose, but it's to do with the individual legislation in relation to the area you're looking at. So I think that was the only questions that came in advance. And I'm wondering now, is Orla ready to go?
I think she is ready to go. But I just have one last very quick question, Rose, that came in while you were speaking there. And I think you partially answered it anyway. Let me just see now, I got it here. Yeah, here we go now. If possible, could Rose clarify the requirement with an individual who lives in Northern Ireland and due to the nature of the role has to travel across the border to the ROI possibly 2 to 3 days per week, now currently working from home as travel restricted, so she has spent time with her family in Dublin and has been working there since February. She's on the UK payroll. Is there a limit to how much time she can legally work in the Republic of Ireland? And should I be telling her to move back to NI to work? ? I'm not sure if we should be tracking her trips up and down each week when things revert to normal. We have 4 employees in this situation, but the other 3 are all working from home in NI currently. Thank you. So
okay, that's an NI employment, is it, Paul?
Yeah.
Okay, NI employment. NI employment and they're traveling south of the border. That's the normal rules, even the pre-COVID rules, is that you have to track their days because I say up to 60 days, you have no requirement to report to revenue, provided they're NI resident and not ROI resident. If they're still NI resident, they're just traveling up and down to work. That's fine, so long as they keep under the 60 days. Once you come 60 days, you do have to notify the Irish Revenue and agree that you will deduct taxes if necessary if they breach the 183 days. So that's even the before COVID rules. During COVID, there was a bit of a relaxation, but for NI employers, it was a case-by-case basis. In relation to the ROI requirement to set up a payroll on the other side of the border, you from 1st of January, you're back to the normal rules. So,
Okay, thanks very much,
so
Rose.
it's a,
Yeah, there are a couple of the questions there which we'll take at the end, if that's okay. So I can pass over to you, Orla, now.
Yeah, it's great.
That'd be brilliant. And thanks very much, Rose. That was very comprehensive.
Okay. Okay, everyone, thank you for inviting me here today. My name is Orla Rafferty and I work as HR consultancy. I also work in organisations who are facing difficulty with employees, anything really to do with employees, and it seems to follow my way. Okay, so we can't connect with each other on a one-to-one basis. So those are all my social media tools if anybody wants to follow me or connect, or if you want to ask any particular questions, I'm quite happy to respond to that on the back of this particular engagement. So I'm going to talk today about Brexit, and I'm also going to touch on the changes that we have seen over the last 12 months and how that is impacting on employees and on employers. So I came across this flow chart and I thought, like, you can take a screenshot of it. I think everybody's going to get a copy of the slides anyway. But I looked at it and I thought, gosh, it looks complicated. And but when I actually follow through on it, it's quite easy to follow. I'm not going to go through it obviously today, but I think that's just give you an idea of what it is like to take somebody on who are outside the EU and you're checking, have they the right to work in the UK? So yes, it's straightforward, but it is a little bit time consuming with that. So following on from that, if I think about Brexit, while we're all starting to open up, hopefully fingers crossed and all the rest, there's one thing that's definitely going to close, and that is the settlement scheme, which is known as the EUSS. And that finishes on the 30th of June. So that would allow anybody from the EU to apply for pre-settled or settled status. Now we can look here and see that in March of this year, almost 80,000 people have already applied with 97% success rate on it. Interesting, because I like a bit of information, a bit of statistics, and we can see that the highest level of nationalities was in the Polish community. And we would look across the council areas, that the highest council area with applications was Armagh, Banbridge and Craigavon, followed then by Belfast, and then followed by Mid-Ulster. And I'm wondering if that's anything to do with the industries that are using that required additional labour way back whenever a lot of nationalities started to come into Northern Ireland. The cross-border studies project shows that there are 23,000 to 30,000 crossing the border to work. Now they're obviously not physically crossing the border as it is now, but there's definitely, you can see that transfer of people moving from and working between both jurisdictions. So the new immigration system, what I would suggest to anybody that even whatever size their business is, and I'm sure larger businesses are doing this, but if you're a smaller business, you need to look and see what is this system suitable for me? Should I be looking at it? So sit down, take the time out, go through your talent pipeline and consider, what do I need for 22 and 23? Can I recruit or train locally? And this is one of the pushes that we've got from government as to why they made the scheme a little bit more difficult, because they wanted people to recruit locally. Now that's okay if the labour is there. If it's not there, then that's a different situation. Bear in mind that there is a big push on apprentices, particularly in the north. And I see that next week is apprenticeship week. So if you can see something that is of interest to you in respect of a webinar, there's really good work that has been done within apprenticeships. There's a lot of funding going towards that way. So if you're interested, then have a look at that. But if your talent is only available outside the UK, or you rely on intergroup mobility, then consider applying for a sponsored license. There you can see the number of people or groups that have applied for a sponsored license. It is an extensive list. If you wanted to take the time, you can actually have a look at it online. So the new immigration system as it is, and I like this visual because it's easy to follow. You need 70 points to meet the mandatory requirements, in other words, to be successful in your application. You can trade points. So if you're being paid a higher salary, or if you're in a job in a shortage occupation, they can be traded and you can get extra points for that. So you can see again that this is the government's trying to get more people to come into the country that are going to add value into the economy. So when we look at certain examples of shortage occupations, we can see here that each occupation is given a code, and the welding trades give it a little bit more detail. I suppose this, because I'm from the Mid-Ulster area, so this maybe give me a little bit of an interest into it. And they're looking for high integrity pipe welders. Looking at that is really gas and the likes of nuclear and oil, which isn't really an industry that's within Northern Ireland. But obviously you're going to have to give a lot of information, because they're saying that people have to be working here legally. So I would say they'd be looking for a lot of information whenever you go through an application for that. A new one that has been put in, which is great, which is the senior care workers, because obviously that is quite a shortage globally to help with our aging population. So, and I had a chat with an immigration advisor just to find out what he was, to get a little bit of feel of what was happening within the immigration field. And he was saying in the last couple of quarters, he had seen a large increase in the demand for companies to go down the sponsored route. And the processing time was taking longer, the license audits were taking longer. So an awful lot of people must, they're looking at it and they're getting interested in this scheme. There's been a big surge in inquiries from the manufacturing sector. He was telling me, Conor was saying that it's mainly in the Belfast area. Second after that is the Mid-Ulster area. So whenever we look at working within Northern Ireland, if we look at the Republic of Ireland, and if you're living there, but you're working within the north, then there's a common travel agreement. So you can travel back and forth. There's no issue. That's always been in place. If you're any other nationality, you need to be aware that the UK immigration rules do apply. That is obviously, even if they're working, they have to be allowed to work, or so they need to have a pre-settled status, or they need to go through the immigration route. If you're a European national working within living within Ireland and working within the north, then we can look at the frontier worker permit might be of benefit to you. It depends, as Rosemary was talking about, the amount of days. If that's an issue, then if you can get in and maybe apply for the EU settlement scheme before it finishes in June. So on the other side, Northern Ireland residents who are working in the south, again, common travel agreement is there. You don't necessarily need that. If your company's asking you to go and work in Spain or France, if you're holding a British passport, that might be a bit of an issue. If you're holding an Irish passport, it won't be an issue. If they happen to be European, then they can work in the south as well, but they still need to make sure that they're right to live within Northern Ireland and they're following on the UK immigration rules. And if they're not European, then obviously the Irish immigration rules apply, and there's a lot of different work permits that you can get for that. But they also will have to have the right to reside in Northern Ireland. So it's a double whammy for anybody in those particular circumstances. So moving on really from that, the changes that have come into fore with Ireland, and this is I suppose it's a bit of both. It's the Brexit, and also it's the impact of coronavirus. I see that Ireland has introduced, and you did touch on it, Rose, there about the resilience and recovery. There's a huge path ahead now, and it's interesting because Rosemary Rose is thinking of her from her side, and I look at it from the people's side and how it manages and how it fits. And I can see there that I'm looking at it and thinking, gosh, that sounds really good from the north, because we don't have any of that type of looking forward and looking ahead as aspect of that. And so I'm going to be really interested to see how that pans out. But the right to disconnect, that is a code of practice that the Irish government are putting into place. And who would have thought that 13 months ago that the Irish government would have been requesting this and considering putting the request to remote working into law? I mean, to me, that would have been totally unheard of. There's also our rural plan, future plan has come into place. With you seen that Minister Humphreys put in announcements actually just this week about hubs being created. There's one Stranorla and Ballabafay and the old Ritz Cinema, and then Cardona as well. An old department store they're going to create into a new hub. And if there's any that are going to be created over the border for me, I might just pop across and work in there because I don't have those facilities locally. So I think those are great things that are starting to happen within the Republic of Ireland. Looking at Northern Ireland, what type of things have we seen? Have we changed? The big move is the gig workers. Uber drivers are workers and they're no longer self-employed. And that is such a big, I mean, they're now going to have to be paid holidays and national insurance. And I'm sure Uber has put money away for the cost of that, but that's quite a big impact for anybody in that particular sector. There's consultation on parental bereavement leave, which will come into entitlements into Northern Ireland employment law. That already exists within the UK, so it's only a matter of time till that comes here as well. Redundancy payments, they always usually are reviewed around April time. So the maximum award per week per year service is 566. So as I said, I think in a meeting before one time, that be aware that whenever you go to Google search, there's a slight difference between it in the UK. So make sure you're looking at any information that relates to Northern Ireland and not necessarily Ireland or UK, sorry. Okay, and that's just a quick update on the proposed redundancies. You can see obviously the peak on that and where that is only out. Actually, those particular numbers come out this week, and it shows you that there doesn't appear to be a drop, but to be honest, I'm not hearing of very many. I'm not getting a lot of inquiries on it, so I think it is changing. And I know that as the country begins to open up, that there's a lot more jobs being advertised, particularly in the catering sector and the restaurant sector, because a lot of people have left those sectors to move to other jobs. So there's a lot of vacancies that are appearing there. And so I'm hopeful that we're maybe turning a corner on that. Times may change, you know, whenever we start looking at the ending of furlough, because by the time July comes, the government are requesting that they're going to be paying 70%, and then employers will be paying 10%. By August, September, it's 60%, and then companies will be paying 20%. So they will be relying on people coming in through the door for them to be able to pay that. So the winding down of furlough is happening in September, with the support scheme then in the south is going to run until June. There's definitely, as Rose has said, about making a shift in the hybrid flexible working. That's a definite. Bank of Ireland has recently introduced and said that they're doing it. You're hearing it every day within the media, that, and maybe the media does pick up on these particular things, but I think that is definitely something that it's going to happen. So this is a big change in leaders and managers and having to trust their employees and letting them just go do the work, and let's see. So maybe it's looking at how they set their performance targets, rather than them being in from 9 to 5, like let's see what you can get done and let's see what you can do between those periods instead of the hours that are worked. So look, let's face it, we are in for continual change, adaptation, and for learning, without a doubt. We've had to do an awful lot of changing within the last 12 months. It's been hard to actually take a time and take a breath. And I think that that is going to continue for some time. Controversially, I'm going to leave you with this one, and a big ethical debate on the future that I'm hearing about, and this is happening in the south and in the north, is no job, no job. And as soon as, whenever everybody, all the vaccination programs are done, how they would ever manage it, I don't know. Is it ethical? Big question. But I think that is definitely going to be something for the future. Okay.
Yeah, very interesting.
Thank you.
That's the last of your slides there now, is it?
That's the last of my slides. Yeah, that's just to finish it there. Yeah.
Yeah, no, that was look, some very positive stuff coming through there as well in terms of the rate of redundancies. There is a concern, obviously you mentioned it there, about the finish of furlough, what's actually going to happen, and the company contributions, which you know, it's going to be a struggle for businesses with cash flow and things like that. There's no doubt about that. So there is a concern that come the winding down of furlough, that people will unfortunately be losing their jobs, and that whole area. And you touch on the apprenticeships, and we see a major focus on that. And in fairness, as a chamber, we've been working on that as well with the council and with the Department of Economy as well, and you know, working closely with the universities in Northwest Regional College to provide these training courses and encourage people, signposting them there. There's fantastic courses available in the Northwest region for people to attend. Really brilliant offers out there at the moment, so we're encouraging people to take up those. But yes,
yeah, and I suppose just and maybe should have said as well that that there is a new visa scheme coming in, obviously for July, and it's a graduate visa. So if you're in here, if you're in university here, then you could stay in the country for another 2 years, and you don't have to meet that particular requirement in you know, in the wages or on the amount of experience you have, which is a good potential for anybody who's looking to recruit somebody maybe that particular way as well.
Brilliant, Orla. Look, thank you so much. And just going back to the questions, Rose, if you don't mind, just to, I'm conscious of the time here, as we're a little bit over the time. I think it's really good to cover off as many as we can. Could Rose give an indication of what ROI firms can do regarding registration for UK VAT when they do not have a physical presence in the UK? It seems registration is not possible, but there still can exist an obligation to charge UK VAT.
The way things sort of changed since the 1st of January because of Brexit is that there's an obligation on a lot of businesses, European businesses, not just Irish ones, to register in GB. If you're selling business to consumer, you're selling goods business to consumer, so you have to register. So it's not a case that you have to have an address in the UK for that. It's if you're doing business to consumer, you have an obligation to register, and you're registering as a non-established person. So those registrations are coming through. There's a huge backlog, though, so they're slow coming through, because it's not just Irish businesses trying to register in GB, it's all of Europe's businesses trying to register in GB. So there's a huge backlog of registration applications. For somebody who's registering for different reasons, for the reasons that they're providing services in GB, well, there's no registration threshold for somebody who is providing services where the place of supply is GB and they're a non-established business. You have to register, and you're registering again as a non-established person. If you're actually providing services in GB in relation to, or in NI in relation to, the fact you're carrying on business there and you're carrying on through not just, maybe this question is actually more to do with companies, because a company can have a registered office address which is separate from their trading address, and sometimes they won't register the business unless they have an established business address and that shows that they're actually in business there and it's not just a brass plate. Maybe that's the tone of the question. I'm not sure, but you can register for that as a non-established business.
Okay, another one here. ROI working for NI firm. Pre-COVID, all work fully in NI in UK. Since COVID, working 1 day a week in NI office. Other for flexible work, homework, on road, or in the office. How should this be quantified?
Is this an NI employer again, is it?
Yes, it's an RI resident working for an NI firm.
Okay. The NI employer, up until the 31st of December, there was a relaxation that they didn't have to set up a payroll in ROI for the duties carried out there. But since 1st of January, that relaxation is gone. They should set up a payroll immediately in relation to that employee and either put them entirely on the ROI payroll, or you're going to have to split it between the duties. It might be 4 days ROI, 1 day NI, but that's quite complex when you do it that way. So if possible, create an ROI employment for them.
Okay, thank you for that. If you have your company in Ireland, but you have employees working in Poland, do you need to run a payroll in Poland?
That's got to do with the Polish rules, but yes, most countries have similar type rules where once you're a foreign employer and you've got people working on the ground in the jurisdiction, then there's a timeline as to when you have to register as an employer. Sometimes it's immediately, sometimes it could be 30 days, 60 days, etc., similar to the Irish and UK rules. So you have to find out the Polish rules. Yeah.
I'll just pop on that. If that is the employees are from Poland as well.
Yeah, there's an issue there like we have under the treaties. So you might have to
no, I'm just thinking on that one because I can remember previously that there was my experience of it is that employees, if they're based in Poland, that it's really easy to get somebody out there to actually administer the payroll for you. And their laws and legislation in relation to working over there are very, very complex. So you would need to get specific advice from somebody in there with that as well.
Yeah, I found the tax rules that have come across in Poland were completely the opposite to what you expect. So yeah, so definitely take local advice.
Yeah, I see they say that their employees are living in Ireland. So maybe I'll leave that one for you then, Rose. Okay. For that particular one.
Okay, yeah, NI worker right now, here we are. Okay, just looking at there. Okay, I think I've covered off most of the questions here. NI employer hired 2 ROI residents and due to lockdown, they have not worked in Northern Ireland office yet.
Oh, okay. I guess since 1st of January, if they're still working in at home in the ROI or just they haven't worked in NI yet, you need to set up an ROI payroll.
Okay, okay. Look, conscious of the time there, and as I say, we're open for business in terms of contacts. If anybody has any questions that we didn't manage to get to, we're more than welcome to filter those to Orla, Rose, or ourselves, or Anna in the chamber. We'd gladly try and support any questions you may have that we didn't get around to this morning. We could have done with more time. It's such a complex topic, but a very interesting one in terms of opportunities as well for the future. So unless Orla or Rose, you have anything you'd like to add there, I just might wrap it up.
That was fine.
Yeah?
Yeah.
So let me just Yeah, look, I'd like to thank you all for your participation today, and I'd especially like to thank Orla and Rose for an excellent and very informative webinar again. If you have any further queries, as said, that we haven't covered, please forward them to myself or Anna, and we'll try our level best to connect you to the information that you may need. And our Chamber greatly appreciates your continued support, and many thanks for joining us today. Apologies for going over a little bit on the time, but I think it was good to just to get to the questions, and stay safe and have a great day. Thank you.